In fact, in the mortgage market, mortgage lending is one of the safest forms of lending that banks and building societies make because you have the collateral of the house. Even if the person you lent money to is no longer able to pay the mortgage after a few years because interest rates have gone up or they lost their job or whatever, the bank or the building society can repossess the property. And at times in the past, that has certainly happened on a large scale. And so mortgage lending is one of the safest forms of lending that banks and building societies undertake. And because of that, the difference between the interest rate the government can get when it issues debt and the interest rate that you and I pay on a mortgage is not enormous, and it's relatively stable. And so the difference between what you might call the safest interest rates, Bank of England rates the government pays on borrowing when it's borrowing for 10, 20, 30 years in the bond market, the difference between those, what I'll call safe interest rates, and the rate that you and I might pay on a mortgage is relatively small. I mean, maybe it's like 1% or so.